this whole expansion is really excessively dependent already on government support. That is not a sustainable situation. And you're starting to see real pressure now showing up, for example, in the commercial real estate market. You're seeing some in residential, but it's really commercial real estate market that's getting hit by this because they are structurally exposed to changing socioeconomic trends, and they need access to liquidity to roll over debt that is starting to become distressed.
What is happening with the global economy and which asset classes are likely to prosper and not do so well in the coming months to years? We'll be talking about this with John Butler. He is the investment director of Southbank Investment Research and the author of The Golden Revolution Revisited. And he is also a contributor to Fortune and Freedom, which we'll put the link in the description down below. John has had 25 plus years of experience working in the financial industry. He was former managing director at Deutsche Bank, Lehman Brothers, and Dresdner Bank. Institutional Investor magazine ranked him as the #1 macro investment strategist at one point. Thank you, John, for coming on the show. Pleasure to host you.
Pleasure to speak to you again, Dave.
Good to see you again, John. We were talking offline about your broader outlook. Let's start top down. You said that you're concerned about a sharp downturn in the global economy, were your words. Walk us through your logic here and what this sharp downturn looks like.
Well, it looks sharp because you're seeing a very sharp contraction in money and credit growth. There was an explosion of money and credit growth as a result of the policy responses to COVID that was quite unprecedented, but now it's coming off at an unprecedented rate. And that historically implies that you're going to start to see liquidity really dry up for the economy. And that really is the lifeblood of the economy. Now, that said, if economic fundamentals are fundamentally sound, there are natural income generating activities that can sustain themselves even amidst relatively tight money and credit conditions. But we don't really have that right now. It shouldn't be lost on anybody that most major countries, including, of course, the United States, are already running recession level government deficits. So there's all this government spending, which really is the only thing keeping the current growth game going. And that severely limits the policy flexibility that will be available to the public authorities in the event that that very sharp contraction in money and credit growth starts to have real effect.
When you say recession level government deficit, what do you mean by that? Are you referring to historically high levels of deficit that have preceded or have coincided with recessions?
They tend to coincide with recessions because other factors equal, and this is true of any modern economy for the most part, including the United States. You have a situation where there are these automatic stabilizers, things like unemployment benefits and other sources of government spending, which tend to naturally increase as the economy weakens and as demand softens. But we're already at that level now. So in other words, in a way, this whole expansion, to the extent that economies are still expanding, they're not in Europe, but they are still in North America. This whole expansion is really excessively dependent already on government support. That is not a sustainable situation. And you're starting to see real pressure now showing up, for example, in the commercial real estate market. You're seeing some in residential, but it's really commercial real estate market that's getting hit by this because they are structurally exposed to changing socioeconomic trends, and they need access to liquidity to roll over debt that is starting to become distressed.
When you say global economies, several countries already are or have been reported to be in recessions. Earlier this year, New Zealand, for example, Germany is another example. China, not yet officially in a recession, but they have reported a contraction or slowdown in growth. Structural problems facing Europe, including demographics, energy, the UK facing really high inflation. Are we seeing these same structural problems in the United States, John?
Less so. let's face it. Europe has a very unique set of challenges, which sadly is associated with they're associated with the tragic war in Ukraine, and that's a specific problem for Europe. That is, Europe has a large manufacturing base and export base relative to the United States. This is particularly true of Germany, Poland, and a few other Central European countries. Basically, for years, they were importing cheap energy from Russia and therefore were very competitive manufacturing exporters to the rest of the world. That whole business model has been blown up by the war in Ukraine, which has cut off their access to cheap energy and caused a range of other problems, including a refugee crisis and so on and so forth. It's a big tragedy, and so Europe has that unique set of challenges. Whereas in North America, obviously somewhat immune from all of that, and yet, nevertheless, you do see lots of disturbing trends in the data. The jobs reports, the employment reports, they look okay on the surface, but when you drill down, you realize that what's holding employment up is government jobs, which, other factors equal, are less productive than non-government jobs. After all, the only way to pay for those jobs is by taxing the more productive private sector jobs, number one. And number two, people holding multiple jobs. That is not a sign generally of economic health. As a general rule, when people are holding multiple jobs, it's because they're trying to hold two part-time jobs instead of one full-time job. And that usually means they receive less in benefits, they receive less job security. That's not really a healthy economic situation either. But what I mentioned earlier about these socioeconomic trends, they're really impacting commercial real estate at a level that is just unprecedented in history. This has become a distressed industry, and the amount of debt that is at risk of non-performance and or eventual restructuring and default is absolutely vast and would blow a huge hole in the banking system. We know what blowing a huge hole in the banking system can look like based on what happened in 2008. I'm not saying we're going to look at we're not facing a exact repeat of that, but history does rhyme, even if it doesn't repeat. And we're working up towards something there due to this extremely tight set of money and credit conditions combined with these socioeconomic trends against traditional needing to go to work in a normal workplace and all the associated retail activity, shopping activity that occurred around those urban retail spaces. That's not coming back, in my opinion.
WeWork this week, speaking of commercial real estate, WeWork, which was once valued at $47 billion earlier this week, filed for Chapter 11 bankruptcy. That's a company-specific issue, though, John. When you talk about the commercial real estate sector facing headwinds, like you pointed out, what is causing these problems and what can happen after this?
Well, again, money and credit conditions are tight, so any marginal business is going to be in trouble refinancing their debt in those situations. This is an area of the market that has traditionally relied, of course, heavily on debt financing as part of its business model. The idea being, of course, that if you're diversified enough across different forms of commercial real estate, that is office space and retail space, they're not both going to head down sharply together in a big way. But now we're staring at the situation where office space has not been able to bounce back post-COVID because of so much remote working in the world today. But retail space already under siege from online retailing is being hit because the workers are not showing up in the urban areas where there is also a lot of excess traditional bricks and mortar retail space. So you're getting this unprecedented double whammy from socioeconomic trends that are negative, combined with very tight monetary and credit conditions. The sector is going to find it very difficult to roll its debt over going forward. And there are going to be huge markdowns. We're seeing some of those now, to the extent that office space is moving in urban centers, to the extent that major retail space, such as urban shopping malls, are moving, being bought and sold. The discounts and markdowns are unprecedented in size and scope.
And what is a consequence of shrinking commercial real estate sector to the banking sector? What's the relationship there?
Well, clearly, a lot of the lending that goes into these projects remains syndicated within the banks as opposed to outside the banks. So they do have holdings here. As a general rule, if you're part of a banking group that's involved in a big commercial real estate deal, you're simply not allowed to sell off your syndicated stake, sometimes indefinitely. That's part of the funding arrangement. That is, and you can understand why. Whoever is the property developer doesn't want the banks that brought them to market to just bail when it's convenient. They want them in for the long haul as a source of marginal liquidity if necessary. So the banks are still on the hook for this. You've got a lot of real estate investment trusts listed in the equity markets that hold a lot of this stuff too. You also have some very high value private equity groups and other wealthy investor groups that have some of this stuff. But the banks themselves have some too. And as we also know, because banks need liquidity in their investments for their balance sheet liquidity management purposes, they also hold a lot of liquid government securities, which have lost a huge amount of value as a result of the rise in interest rates. I mean, some people are saying that this is approaching $1 trillion at this point in the United States. That may be a slight exaggeration. People love round numbers. But nevertheless, that source of liquidity is not quite what it used to be when rates were a lot lower. So there's all kinds of things converging here that, in my opinion, point to a very sharp downturn in economic activity. You've already seen it in Europe for reasons I mentioned, and you're going to be seeing it in North America and other parts of the world.
So let's say you've got a commercial property that is, I guess the owner went bankrupt, or they're no longer in need of that property. They stop paying the rent on that. What happens after that? So are you expecting real estate to be sold off? Or are you expecting just landlords to hold on to empty assets for a while? Are you expecting the banks to write off some assets? What happens once the music stops, basically, is my question.
Well, it's interesting you asked that question because we actually have quite a recent example. Again, it's not a perfect parallel, but it offers some instructive observation here. And that is what happened in the mid 2000s. You already saw some of the more dynamic property markets beginning to slow in 2005, 2006. For example, this was true in parts of California real estate, residential real estate primarily. And then when you moved through 2006 into 2007, it was clear that slowdown was getting to the point where there might be some outright declines in some of these regional property markets that had been really, really hot for a while. And yet there was a tremendous reluctance within the industry to acknowledge that and to begin to write anything down. The moment you start to write something down, you're basically telling your institution, whoever employs you, that you're not going to get paid a bonus that year. Now, of course, you can have the internal risk management team, you can have the internal valuation team trying to reason with senior management saying, look, we have to be realistic about this, or we're effectively misstating our financial accounts. But there can be tremendous resistance to finally biting the bullet, acknowledging reality, and formally writing down assets. So the fact that only triggered a true blowup in 2008, even though the slowdown was occurring arguably in some markets already in 2005, although 2006 is the more obvious transition year, that sort of resistance is probably being seen now. I suspect because, of course, there was no fundamental reform to any of this post 2008. Lots of talk, but no fundamental reform. I suspect the same sort of institutional reluctance and resistance is still very much in place. People are either in outright denial or they're well aware what the consequences would be if they took the write down hit now. So we haven't seen it yet, but it will happen. I just don't believe there's any avoiding it this time around. And the idea that the government can just jump in and throw a lot of money at the problem when it's already running recession level deficits, I think is a mistake. I think it's not clear at all that we have the same degree of fiscal, or for that matter, with inflation still elevated, monetary flexibility to deal with a real estate blowup this time around.
The Fed funds rate is 5.25. It's exactly the same rate as it was in 2007. Are you surprised that the residential real estate market has not yet seen signs of capitulating like it did in early 2007? Keeping in mind that the Case-Shiller index was already peaking and top and rolling over by late 2006. So why aren't we seeing that pattern right now in the residential real estate space, despite the fact that rates are the same at the exact same rate?
I would say there are two reasons for that. One of which has to do with the changing structure of the market, and the other which has to do with simply the fact that residential real estate tends to be less volatile anyway. It tends to be less volatile because it's less geared to the business cycle and it has more to do with consumers and households' longer term financial plans and programs. But the changing structure is important here also because a disproportionate amount now of US residential real estate is in fact owned by large investment groups who then, of course, rent it out. And they have deeper pockets. They're less likely to just walk away. And indeed, they might have some options regarding various forms of restructuring of their debt, restructuring of their credit lines, and whatnot to kind of keep the party going a bit longer, longer than it would otherwise be the case if it were just a typical household that where someone suddenly lost their job and they had to walk away from their mortgage. So I think there's a couple factors, one of which is very traditional, one of which is a bit newer, that help to explain the relative lack of action, at least downturn action, as it were, in residential real estate. So commercial real estate is where things are turning down sharply right now. But residential may follow, if I'm right, that this is all part of a general global economic slowdown due to very tight monetary and credit conditions that cannot be easily buffered by a sharp increase in government deficit spending because deficit spending is already at historic recession levels.
And you mentioned that you don't think that this real estate, commercial and or residential, these problems that we're facing, they may not be as severe as 2008. Why not?
They may not be because to some extent, I mean, don't get me wrong. I mean, sadly, what we learn from history is that people don't learn from history, but that's a generalization. Some people do. And I do suspect that when you look around the real estate market, there are some people who have been a bit more conservative this time around who don't want to go through a repeat of that. That's just a guessing game, really, on my part. It's very difficult to know. All I would say is that I think some people are calling for an even bigger blowup than 2008. Now, I'm not ruling that out, but you don't yet see that in the data with residential real estate. Commercial real estate could go through a bigger blowup, yes, than in 2008. That could happen. That is beginning to show up in the data. And again, the socioeconomic trends that I mentioned contribute to that. But residential, it's not yet there. You don't yet see it. The problem, however, is that we went into 2008 with with central banks having more flexibility because, as you mentioned, rates were at a reasonably high level and inflation was much lower at the time. Well, I mean, it was lower. It wasn't much lower now that inflation's come down a bit, but it was lower. And governments were not yet running recession level deficits. We don't have that this time around. So the potential for the downturn, I believe, is collectively that much larger.
Let's look at market signals now. You made a comment to one of your colleagues in the Fortune and Freedom newsletter. You said that I'm looking at various cross correlations and they're beginning to break down across the board. The usual relationships between interest rates, curve steepening, flattening, stock versus bond versus commodity correlations, gold, FX, etc., are just all over the place. To me, this is a possible signal of general distress. Can you give us some examples?
There have been a number of these historically, and it's interesting because one of the most common, popular, and to be fair, successful methods of investing in recent decades has been so-called risk parity, where you have a fund that is able to invest in a range of assets and follows a policy of taking historical volatilities and correlations together with a number of other assumptions. But they take these historical time series and then they run through a number of matrix multiplications. They might have binding constraints around some of the extreme moves that could take. And then what they do is they say that, okay, each asset, each position in our portfolio will contribute an equal amount of risk to that portfolio. And then you calibrate the risk of the portfolio, which is as efficiently diversified as possible, because that's what risk parity implies. You calibrate it to a given return target. And that return target for an aggressive fund might be 20% per annum. For a less aggressive fund might be only 10% per annum. But that's the approach. Now, that approach depends on the correlations across the assets remaining more or less stable. If they start to become unstable, that suggests that a huge amount of money is being managed in a way that is requiring people to adjust positions, and it's forcing selling. It's forcing people to take losses. You don't do strange things with your portfolio when you're making money. You do strange things with your portfolio when you're starting to lose money and you feel you need to de-risk, and you can do so that optionally on your own accord as you think conditions warrant, or, and this is where it gets systemic, it's forced on you. That is, a bank calls you up. They look at your whole credit line across all the assets you're borrowing against, and they say, we're terribly sorry. We're going to have to reduce your credit line. We're concerned about the overall amount of risk that we've extended to you through our prime brokerage credit operations. That, I believe, was starting prior to the somewhat more dovish central bank rhetoric that began to trickle out just last week and gave the markets a little bit of relief in the latter half of last week. That was playing out, and I thought there was a lot of evidence that it would simply keep on playing out if we didn't get something to abate it. And so we have seen a bit of a response from the monetary authorities already. If it continues, we might see a bit more. And it could be, although this is not certain, it could be we have now reached the end of the rate hiking cycle and the next move is down. That could well be the case.
A few correlations I'd like to pick your brain on. The first is the relationship between gold and stocks. And so what we've seen, or what the market has seen in October, is that the gold price has rallied sharply ever since the beginning of October into basically last week, the end of October, when it started to taper off again. We're now trading at below $2,000. Once again, 1951. I'm looking at my screen as of Wednesday, November the 8th. Now, the stock market has shown some resilience in the beginning of the month as well, rallied most of its losses back. So it's basically flat on the month. Gold and the stock markets just don't or haven't been in the last couple of months moving in any sort of fashion that you might expect from a safe haven if you were to assume that stocks and gold would move in the same or opposite direction if there's volatility in equities. Is that assumption wrong, John?
It really depends on your time horizon. This is one of those funny things. There are times when gold is positively correlated with stocks. There are times when gold is negatively correlated with stocks. And when you look at long time horizons, 3 years or longer, say, what you find is that there is no statistically significant correlation between gold and stocks at all. It's almost uncanny how this correlation approaches zero as you expand your time horizon. Back, and eventually, I mean, it really is zero. I mean, if you run, 70, 80, years of data, it literally is zero. And a lot of people scratch their heads about that. They're thinking, well, wait a minute, stocks can rise with inflation and gold can rise with inflation. So why aren't they positively correlated over long periods of time? And the simple answer is that they respond to different types of inflation, and they respond with different leads and lags vis-a-vis those different types of inflation. There is healthy inflation that can occur when an economy's real growth rate is actually at or above trend. And there's unhealthy inflation that can occur when an economy's real growth rate, inflation adjusted, is below trend. The two are extremely different when it comes to corporate profit growth, and therefore they're extremely different regarding how the equity market reacts to them. Whereas gold is much more just concerned about being a store of value. Yes, it can also be a safe haven when crazy geopolitical risks or whatever else happen around the world, by all means. But really, that helps to explain it. So you just don't see the same coincidence in the correlation, which is one reason why I have recommended throughout the last probably 15 years of my career to always diversify a portfolio of stocks with a meaningful holding of gold, which I've always said should be at least 10%. And at times of systemic stress can be as high as 50%.
I've noticed you use the word diversify with gold and not hedge with gold, with the caveat difference being that diversifiers usually don't have a significant correlation, like you mentioned, over the long term, and a hedge is usually meant to protect losses. Did you make that distinction on purpose?
I did make that distinction on purpose, although it's funny, I wasn't thinking about it at the time, but that's exactly how I think about it. That is, gold is not a direct hedge against equity losses. There are direct hedges, of course. You can buy put options. There are hedges that are absolutely direct vis-a-vis losses in the stock market. Gold does not tick that box because the relationship it has with the stock market is far more complex, as I tried to explain briefly a moment ago.
Okay. Now, the other correlation I'd like to ask you about is the 10-year yield versus the U.S. Stock markets. Let's take the S&P 500 versus the 10-year. Just over the last 3 months, I'm looking at a chart here. They've been having a perfectly negative correlation almost. Again, throughout history, we've had positive correlations, we've had negative correlations. What do these correlations mean when they move together versus when they move apart?
It has to do with whether the bond yield movement is indicative of monetary conditions tightening or loosening. So you have situations, and we had a lot of this in the 80s and 90s, for example, when bond yields trended more or less lower with the occasional big interruption for sure. And that made stocks look relatively more attractive because the trade-off, the opportunity cost vis-a-vis receiving a bond yield made stocks look relatively more attractive. And indeed, the Federal Reserve came up with a simple valuation model for the stock market based on the level of bond yields, which they used to refer to when they were trying to get a sense of whether stock markets were in a bubble or not. So that's a phenomenon that's been observed in the past multiple times. But then sometimes you have periods of negative correlation. That tends to be more likely when there is some sort of distress in the economy. That distress can be exogenous or endogenous. What I mean by that is there can be some sort of exogenous shock that hits corporate profit expectations hard, that sends the stock market into a tailspin. And so bond prices rise as people expect rate cuts and stock markets are falling, negative correlation. Alternatively, it can be endogenous when the stock market is racing away because perhaps the economy is overheating and the central bank thinks, oh my God, we've got to get on top of this and raise interest rates sharply. Bonds sell off as stocks are still going up. Once again, negative correlation. So the negative correlation tends to be observed in periods when economic uncertainty is greater, and a positive correlation when you have more of a Goldilocks type environment.
Okay, well, given your outlook on the broader economy, which we discussed at length, how does this translate to specific asset classes? Let's start with the stock markets. There's two ways to look at it. Recessions have historically been bad for stocks. That's a pretty straightforward outcome. The other outcome is the Fed eases dramatically in response to any significant or sharp slowdown, which could actually boost equities. Which is more likely, you think?
Well, look, gauging the Fed's reaction function has become perhaps the most popular sport in financial markets in recent decades. All this speculation about the Fed put, as it became known as, what exactly will trigger it? Well, nobody knows except the Fed itself, although it's kind of a sad commentary on the state of modern capitalism when the single most important thing that people debate in the financial markets is what this unelected bureaucracy in on Liberty Street in New York City, or alternatively at the Federal Reserve Building in Washington D.C. is going to read in the tea leaves on any given day. It's an interesting comment on what you'd like to think is a dynamic, largely private sector driven free market, but that's where we are. So look, I don't have the specific answer to that, but I will offer the following. The Fed has an inflation problem. The Fed has a credibility problem, and they're not alone. This is true of basically every major central bank in the world. And they don't seem too concerned about it in terms of they don't think that it's going to lead them to ruin, and they're not talking doomsday. But then, of course, they're paid to be cheerleaders for their policies. That's fine. I get that. But I think we're in a situation now where the real resource constraints in the world are simply at a level that is so above and beyond what was seen for a long time. You've had all kinds of lingering supply disruptions from COVID lockdowns that haven't been fully resolved. You have geopolitical conflicts that are cutting off huge portions of world trade and or making that trade more just kind of sticky and there's a lot more friction in it. You have the risk of outright trade wars, which, depending on how you define the term wars, might have already begun in many cases, such as regarding tech between the US and China. And so you have a lot of structural headwinds that that are going to result in what I believe is a very, very unpleasant growth inflation mix. That is, to the extent that the economy can grow, it's going to trigger a lot more inflationary pressure because of supply bottlenecks, inefficiencies, and just a generally unproductive distribution of resources and limitations in those resources. So it limits everyone's flexibility. It limits the Fed's flexibility if they want to try to keep inflation down. So it becomes a really tough one here, figuring out what's going to happen. I think that it's clear, however, that when push comes to shove, the powers that be they governments working the fiscal levers of policy, or central banks work for inflation over a little less in order to try to squeeze a bit more near-term growth out of whatever they can squeeze it out of. That's, I think, where we are. And it means that you still have to be biased towards stocks. However, biased in a way that favors defensive sectors and dividends over growth. And that's something that hasn't been seen for decades. We have not seen defensive and dividend high yielders outperform growth for decades. And that's the best strategy of all. Go for dividends, go for defensives, go for value. And if you're worried about the geopolitical state of the world, you also go for gold and you go for guns. You buy precious metal miners and you buy defense stocks.
Speaking of gold, we spoke exactly a year ago, you and I, and back then you told me that long term there is a possible scenario in which gold could reach 50,000 US dollars in nominal terms. You're not saying it's going to happen tomorrow. Let's rehash that thesis here. What does that world look like?
That's a world in which the dollar has lost its credibility as a reliable long-term store of value. That's the world in which, who knows exactly what the trigger would be. Perhaps the US imposes sanctions on too many countries and they decide to not use the dollar anymore. Perhaps there's a general loss of faith in the investor community to see dollar assets, especially US treasuries and the dollar itself, as reliable stores of value. And so they decide to switch out of dollars into something else. The problem here is that the whole world is awash in debt. The whole world has over-leveraged financial systems that could, in theory, collapse if not somehow bailed out by printing money. No one really has a strong interest in a strong currency. A strong currency, therefore, has become kind of a political hot potato around the world that nobody wants to hold for very long. That unleashes an interesting game theory dynamic that I write about extensively in my book. The only way that game theory solves for a situation in which nobody wants to hold the hot potato is to get rid of the potato. That is, you get rid of the whole concept of an unbacked fiat currency that can be devalued at will by any country's government or central bank. Everyone is therefore forced, as per the Nobel Prize winning reasoning and logic of John Nash, everyone is forced to agree to transact in a currency that nobody can manipulate and devalue to serve their national interests at the expense of other countries' national economic interests. And that one currency, when you look at history, has always been either gold or silver. Obviously, more gold in modern times, but silver was used tremendously throughout history too. I believe we are probably going back to some sort of either informal, de facto, it is that what it is, gold standard, as governments scramble to try to find some way to still trade with each other amidst national fiat currency chaos, or perhaps it comes out in a more formal way. Countries get together, hold a conference, kind of like Bretton Woods, decide that this experiment with fiat currencies that began in the 70s isn't actually working out so well for people, and that maybe we should try doing that which underpinned the single most prosperous period in entire recorded human history, which was the Industrial Revolution, when growth rates, according to economic historians, were in the double-digit percent per annum for decades at a time, when entire families, generations were lifted out of poverty into prosperity in decades, not centuries. The world has never seen anything like that before. And all of that happened when the world was on a gold standard. Why wouldn't we want to see something like that happen again? Anyway, I think we're going back to something like that. And that's why I'm actually optimistic for the longer term.
Let's just think about this as a thought exercise. So suppose that the US dollar loses its value for whatever trigger that may be. Regardless of the catalyst, wouldn't capital flow out of the dollar into another fiat currency that the market deems safer? Why would it necessarily flow to a hard asset like gold?
Well, see, initially it might flow to other fiat currencies, but the problem is that that means the US is basically exporting its deflation. And if no currency wants deflation because everyone has excessive debt they're carrying, everyone has excessive leverage in their financial system, they will then compensate by printing more of their own currency. And you get into this competitive devaluation race to the bottom. That's the hot potato. And so I believe that that simply can't last very long. And the reason why is because if everyone is devaluing versus everyone rapidly, nobody can really trade with each other anymore. And the world economy is way too integrated, way too complex. Way too many countries are dependent on other countries' exports. And as a result, when people realize, oh my God, if we don't come up with some arrangement to still trade with each other, we're not going to be able to feed ourselves. We're not going to be able to clothe ourselves. Really severe economic hardship. If it gets to that point, I hope it doesn't. If it gets to that point, it is obvious you choose a neutral currency that nobody can print, nobody can devalue, and one that underpinned the most prosperous period of economic growth in recorded human history. To me, it's a no-brainer, but I do think it'll take policymakers today a little bit longer to figure that one out.
You've actually talked about this in your book, The Golden Revolution. You suggested we are moving towards a multipolar world that will be united under the use of a gold standard. We've seen this throughout history. Actually, the classical gold standard before Bretton Woods was before World War I. And that, I'm just going to throw this out there. It didn't stop us from having a world war. I'm not saying the gold standard was to blame for it. I'm just saying a unified global gold standard or monetary system didn't prevent nations from fighting each other. So could you expect a multipolar world to be just as volatile as pre-World War I, even if we go back to some sort of unified monetary system?
It's very hard to know. And again, gold's a rock. So blaming a rock for World War I think is, I think it's a mistake. But And incidentally, the first time the entire world went off of a gold standard, was World War I and the aftermath, the interwar years when the U.S. also devalued very, very sharply versus gold in 1934. And so, anyway, the thing is this: is that the world's an imperfect place. Human beings are imperfect. We aspire to always make the right decisions. But again, as I mentioned earlier, what we learn from history is that we don't learn from history. And therefore, the Greeks understood things correctly. History goes in cycles. And it is simply inevitable, as the Stoics, of course, have argued so cogently, that cycles require you to go through dark periods. That's just the way it is. And World War I breaks out for reasons that are complex, and historians debate to this day. My own personal view has to do with the politics of oil. That's controversial, but there are actually quite a few people who interpret it that way. In any event, there's no reason why this particular cycle cannot go back to a better place, where we relearn, however painfully, some of the difficult lessons of history. And we realize, and today is different because we have nuclear weapons around, that war has a natural limit beyond which you simply do not go anymore. We didn't have that in World War I, and we have that today. The idea that you could have death on the scale of World War I today and have countries not threaten the use of nuclear weapons. No, they probably would. If you start getting into casualty levels, countries will start to say, look, if you keep prosecuting this war, we're gonna, whatever. That, I think, imposes a natural code of constraint on bellicose behavior. And I'm optimistic. I'm optimistic that a combination of the world realizing that they desperately need a neutral, non-national hard currency with which to trade with each other, and they desperately want to avoid nuclear conflict. I think that combination could take us back to some sort of very stable, prosperous, peaceful age in which we achieve things globally that historians will marvel at someday in retrospect. That may sound absolutely misguidedly optimistic to some people, but what's the alternative? Imagine where else we end up. So I hold out hope that we're on a difficult, twisty, windy, scary road, but that's where it's leading us, in my opinion.
Well, this is what history has taught us, if anything, is that the most peaceful times throughout our recorded history happened during times when there was one dominant superpower, one or two. Happened during the British Empire, the height of the British Empire. It happened when America rose as the hegemons post-World War II. The Cold War saw a rivalry between the U.S. and the USSR, but no real hot conflicts broke out. Now, one could assume that if we enter a multipolar world, the era of peace could fade. My question is, well, two-part question. First, do you agree with that assessment? And second, is a unified monetary system, generally speaking, a solution? I mean, it's inconceivable for Eurozone members to attack each other, for example.
Okay, on the first question, there's a big difference in my mind, which I just alluded to, between a multipolar system without nuclear weapons and a multipolar system with nuclear weapons. The fact is, in a multipolar system with nuclear weapons, even a tiny country with a handful of nuclear weapons, or say maybe a couple hundred, and I won't mention any names, but there's one of those in the Middle East, we believe, could stand up to a superpower. That's a very different multipolarity than what we saw in World War I, for example, when a small country such as Belgium couldn't do a whole lot against being invaded by Germany. Had Belgium had nukes, do you think Germany would have invaded Belgium in 1914? I don't think so. And World War I would never have happened. Okay, that's one big difference. The other one about the currency. Again, the nice thing about gold as a currency is it doesn't need to be formally unifying. It doesn't need because no country can control it. It's a rock. And as a result of that, it's not as if countries need to agree monetary policy. It's not as if they have to agree fiscal policy. They can do what they do, and interest rates and stock prices and bond prices will adjust, and that will impose a degree of fiscal and monetary discipline. They might make mistakes, but they'll be forced to learn from those mistakes, or they won't be able to trade on favorable terms with other countries, with obviously very negative potential consequences. Gold is this kind of natural automatic stabilizing mechanism that doesn't allow any one government to try and abuse some sort of artificially dominant position. And that, to me, it's kind of bizarre that you ask the question in a way, because it almost allows us to have a conversation where on the one hand we can say that this horrible, although in some ways miraculous, nuclear technology enables a multipolar system to become stable and peaceful, and this ancient rock that has served as the monetary base for, again, the most prosperous, peaceful periods in world history for the most part. In a way, they complement each other, and they allow us perhaps to get to some place that we've never been to before in history, which could be the best place we've ever been. And coming from two very different directions, one the oldest of old, one the newest of new, one with zero destructive potential whatsoever, one with unlimited destructive potential, and yet both having a restraining, disciplining effect on the worst aspects of human nature. It's quite something when you think about it.
Interesting food for thought. I like to end on your investment strategies overall. We've talked about diversification. You've written about this extensively. You've shown in your one of your reports that with a diversified portfolio, you can actually outperform the FTSE 100 by, in your particular example, 7 times. I have to recall one of my earlier finance classes at McGill when I was in college, where the professor was saying that 40 stocks is the number to go. Beyond that, you're diversified. Under that, you're not. Okay, so that's an academic. His definition. My colleagues and I were my classmates and I were joking offline. He said that you don't need to be diversified. You just need to be concentrated and right to make money. So I like to just talk about diversification a little bit more. First of all, is there a rule in which, like 20 stocks, 30 stocks, 40 stocks, whatever that is for you, over which that is diversified, under which you're not? And second, do we need to be diversified to make money?
I think in the long term, you need to be diversified to make money, because you're only ever going to be consistently right during brief periods of time when you get lucky. And so over the long term, I really think you do need to be diversified. That said, my own investment mantra is that the best approach is to try and have a view, but only ever have a view when you truly, honestly believe that you have asymmetrically superior information somehow. And that can take infinite possible sources, right? It can be anything. But when you have that, feel free to take a view. But even then, when you take a view, always diversify the view. And this, I think, is the mistake a lot of people make. They get so ginned up on their own ideas and their own view that they concentrate too much and they don't diversify enough. And so what I try to do in the investment processes that I've designed through the decades, including the one that you've just referred to, it's to effectively force diversification into the portfolio and only allow the view to be expressed within that diversification constraint. So you actually start with the diversification constraint, and then there becomes a maximum sort of force that any given view can have on that diversification. And then to run the numbers on that, if you take perfectly uncorrelated assets, which we mentioned gold in the stock market earlier over long term, but within the stock market itself, it's difficult to find perfectly uncorrelated assets. You've got cyclical sectors, you've got defensive sectors, and then you've got some of these sectors that are a bit quirky and don't exactly fit into either of those two boxes. but you don't really have many assets that you can claim are perfectly uncorrelated in the stock market. Stocks are stocks to some extent. Okay. But if you did have perfectly uncorrelated assets, the way the maths work out is that even in the high single digits, the incremental diversification benefits of adding another asset are diminishing so rapidly that the time involved in finding them, getting them into your portfolio, and rebalancing and running that portfolio, they start to approach zero. You're on an asymptote at that point. When it comes to the realistic world we live in of the stock market, uh, and you look across it, it's actually amazing, though, how much diversification you can get. So look, you mentioned the FTSE. If you look at the FTSE, did you know that the energy sector is only about 0.2 correlated with the broader market? I mean, that's low. It's not zero, but it's low. And then you have some other sectors that are also correlated quite low with the broader market, healthcare, for example. And if you look at those cross correlations, the FTSE, I think, is maybe one of the most underrated indices in the world. Okay, fine. The UK might be a small economy nowadays, but the FTSE is a global index. Revenues as a portion of international versus domestic is far higher than with the S&P or the Dow, for example. Okay, so you have a very global index. And the diversity within that index is actually quite large. One negative, if you're negative on financials, which I currently am, is that the financial sector is a huge portion of the FTSE. But you can easily adjust for that in your diversification strategy. And you can just say that you're not going to weight financials by market cap, but by risk contribution. And if you do that, you've got a much better index. And so my investment methodology for the FTSE is a risk-weighted approach, which downgrades financials very, very dramatically within the index and puts you on a much better risk-return spectrum. And when you do that, the FTSE actually is not a bad investment universe. There's a lot of good value there, a lot of high dividend yields, and a lot of diversification available, both industry sector and also globally. There's pretty rich pickings there for people that want to take a value-oriented, high dividend, defensive approach to investing at present, which I personally do.
So you've talked about diversification. How do you select the securities then? You mentioned Markowitz earlier, I believe. Are you using a quant method like the Markowitz model, which is a way to optimize risks versus returns, the most efficient, optimal portfolio? Or do you look at fundamentals of companies? You just pick companies you like, which is a bottom-up approach?
We combine qualitative and quantitative. The qualitative part has to do with the view. You do take a macroeconomic view of where you are. Are you in expansion? Are you in slowdown? Are you in recession, or are you in recovery? Based on that judgment, which has quantitative inputs, but is ultimately a qualitative judgment call, you select the sectors you want to be overweight, and the sectors you want to be neutral, and the sectors you want to be underweight. Based on that qualitative designation, you then churn them through the actual quantitative observed historical volatilities and correlations in your investment universe, in this case, the FTSE index. That then gives you exact numeric weights that you want to target. However, we don't want to get into spurious accuracy with a process that is already combining qualitative and quantitative aspects. So we work in round numbers from that point forward. So we avoid spurious over-optimization, which will only distract us from the bulk of the risks that we're running and our ability to adjust that risk as conditions warrant.
Okay. And finally, how do you feel about the efficient market hypothesis? I actually had the pleasure of interviewing Eugene Fama a while ago, the father of this theory. And he's a staunch advocate of this theory, as you know. And proponents of this theory believe that over a long period of time, you really can't consistently beat the markets because all available information is already priced in, unless you engage in insider trading, which, we're not condoning people to do, but that's kind of the theory here. Do you agree or disagree?
I disagree for two reasons. Number one, I believe in extraordinary popular delusions and the madness of crowds. I believe that the market really does lose its collective mind from time to time. And we've seen many of these boom bust examples throughout history, and actually a disproportionate number in my own investing lifetime. And I believe there is information there that one can use prudently, diversified, and without excessive leverage to outperform the market. But there's a second reason, which is more philosophical. And that kind of has to do with the existential approach toward life, the fate versus free will question. If the efficient markets hypothesis is true, then we're fated to that return and only that return for however much risk is involved in getting that return over time. That to me is an unsatisfying way to go through my investing life. The same way accepting fate and predestination would be, for me personally, a really uninteresting way to go through life, seeking my own fortune, happiness, whatever for myself, my family, children, and so on. And so I take the existential approach that life is what we make it, and you have to try to find meaning. And as an investor, that means you have to try and outperform.
Okay. Well, all we can do in our life is to try our best. Thank you for coming on the show and trying to educate our audience. We appreciate it. Where else can we learn more about you and your work? I mentioned you have a book. I mentioned you have a newsletter. Anywhere else, John?
Well, again, as investment director of Southbank Investment Research, interested parties can always visit our website at southbankresearch.com. Most of what we do is behind paywall. You need to subscribe. However, there is a lot of descriptive material that is available in front of paywall. And then the website, we also run fortuneandfreedom.com, which you mentioned earlier. That's also in front of paywall. So if you're interested in learning more, there are ways to do so without subscribing.
Excellent. John, thank you very much for your time today.
My pleasure, David.
And thank you for watching. Don't forget to like this video and subscribe and follow John's work in the links down below.